Okay, let's talk about some earnings. Shall we kick off with Disney?
Let's do it.
Disney's a fairly recent one. It came in last night. We're recording this on Thursday, as Steve said earlier. But that stock is going up at the moment. It was up about 5% when I looked earlier today on the exciting news that Paul is doing victory laps as a result of being he has a decent chance anyway, being right about something. As my bold prediction that McDonald's is down?
Google is nearly flat. Disney is nearly flat now. Yeah, it was 5%. It's just gone all the way down.
Okay, so Disney, as Bob Iger reverses his decision to... No, I don't know. But, yeah, Paul is doing victory laps because he might have got a prediction right this year, which is one more than he managed last year and one more than I've managed since we started doing them. But here's the kind of numbers from last night's earnings report then. Revenue came in at $23.5 billion, which is 8% higher than it was this time a year ago. The parks continue to push revenues higher, up 21%, and the media segment, which is Disney Plus and ESPN and all of that kind of stuff, was up a mighty 1% in revenue from what I can see here. Earnings per share was just short of $1, which is down around 7%. The parks were up again, and media went to a sort of small loss. Up 25% is what I've got written down for parks. Disney Plus subscribers were down by 1%, revenues were up by 13%. Losses widened from 593 million to $1 billion or so. But here's the bit that matters. Bob Iger has asked the board, or is asking the board, or is going to ask the board to reinstate the dividend in time for Paul to be right that Disney will pay a dividend this year. Unbelievable scene, Steve.
Yeah, absolutely. Yeah, hats off to Paul for calling that one. I don't think even he really saw it coming. I think he was just scratching around for a third prediction. So interesting that it's coming. I personally don't feel like it's the right time. I don't know if you want to give some quick thoughts on that before we look at the earnings call.
This feels like all the wrong sorts of moves to me. I don't know why they want to pay a dividend. Do they think they have enormous amounts of excess cash lying around? Or do they think they have some excess cash lying around? Or do they think this is a way of trying to push their stock price higher? Because it might be successful in that last case. There may well be a category of investors who think, no, I want this if I can have a 0.2% return each quarter or something like that. But I'm not in that category of investors, but I don't see this as an obviously right move for Disney.
No, me neither. I just refreshed the page, Steve. We are actually now down 1.63% on Disney,
Casper.
Which is that's smoke and mirrors, isn't it? That's exactly what Iger tried to do today. He tried to hide a pretty mediocre-looking report, especially on the media side. The actual park side did excellent. The core, I would call that the core part of Disney's business, probably. That did excellent. But the actual media side, it didn't do very well, and it's probably not going to do as well going forward because of some of the things that were in the earnings call. The main bits that I've pulled out were that Iger's looking to make $5.5 billion worth of savings, and he's going to make this by reducing non-sport licensing spend by $3 billion. So for me, this is a clear sign that Netflix has won this little streaming race between Disney and Netflix. Disney is bowing out, essentially, I think, at this point. They're saying, right, okay, you have it, Netflix, you've got the money to spend. Which is amazing when you think about it. Netflix has got to the point where it is outspending Disney, and Disney is retreating. Incredible. But the other $2.5 billion is going to come from a 7,000 person headcount reduction, and $1.25 billion of marketing costs reduction, and some other incremental savings. And we won't see all of that until 2024. Iger said that Disney Plus was on track for profitability by 2024, which is exactly what Chapek predicted pre-sack. Disney's ad tier should start making financial impact by the end of this year. At the moment, they were saying it was pretty minimal effect. Disney are actually going to restructure into three main units again, Steve, for the 88th time. We're now going to be entertainment, ESPN, theme parks and experiences, which led to the analysts saying, oh, look, this is strange that you're putting ESPN on a bit of a pedestal. Are you going to spin it out? And I said, no. ESPN as a brand is very healthy. We're not engaged in conversations right now or considering a spin-off for ESPN. I bet you, Steve, that span off within a couple of years. I can almost guarantee it. There's no reason other than that to do it. So the last bit I got was just to congratulate Paul on Iger bringing back what he called a modest dividend towards the end of the year. I wonder what that's going to be, but I would assume it's not going to be anything very exciting. I think it's going to be under 1%, maybe even 0.5%.
Yeah, it wasn't terribly exciting from a yield perspective before, was it? Sort of before, I think it stopped around the pandemic, right? And they'd only recently kind of gone quarterly with it before then.
Yeah, it was a 1.6% or something, was it? It was not much at all. The Disney share price was quite a bit higher as well, though.
So, I guess a few things to keep an eye on now. I was interested in the restructuring. Disney I found annoying when I first started looking at it because I was trying to figure out what all these moving parts were. And then I managed to get my head around what was going on because the earnings reports as I see them now, maybe it's just what I'm used to again, but break things out in a way I can understand. They have the revenue, and then under that you have parks revenue, and you have media revenue. Basically, under media revenue you have ESPN and the linear stuff, and then you have underneath that the Disney Plus things, and breakdowns from there by kind of region and Disney Plus and Hulu and so on and so forth. I kind of was okay with that, but they're separating out then the linear networks, ESPN stuff. ESPN, I think, is a reasonably strong brand in as much as I like US sports, and I quite like... I'm looking forward to the Super Bowl this Sunday. I'm not particularly interested in hearing an awful lot of stuff around it, but I am looking forward to that. I watch it pretty much every year, and it's a nice opportunity to stay up while the rest of my house has gone to bed and eat nachos, although it didn't work last year because the rest of my house came down and started eating the nachos with me. Anyway, back to Disney. I wonder about spinning it out. I sometimes wonder when companies restructure like this whether they're a bit wary of the kind of comps that are available, because it's harder to comp these things if the business unit didn't report as well before. But this doesn't look quite like that. I mean, you could still do it if you wanted to because they report ESPN. They break out Disney Plus in part of their media segment. So that was the other thought that was in my mind with restructuring. But I'm interested if you think it might be going.
I don't see any reason to make it one of your key points, unless Disney are going to try and pivot really heavily into sports. They could be. That could be what they're trying to do. I just don't think from what they announced yesterday that there's any reason to really organise in this way. The other problem I had with it is that, the reason the Disney dividend got cut was because of how bad it looked to be paying a dividend when nobody was at work in essentially in corporate America. So I wonder how people will feel about a 7,000 head cut reduction, which is essentially going to fund the dividend. It's no better, really, is it? It's not a better image for Disney, and I wonder how that will come across. I know the Disney family are sort of quite vocal about things like this, aren't they, and about the way the staff are treated. And I would assume this is not going to go down without at least some kind of statement from the Disney family.
Yeah, I wonder what Nelson Peltz makes of it.
That's what he wanted, wasn't it? This is almost exactly what he wants. He hasn't got a board seat. He's been told he's useless, and then they've done one of the things he asked them to do.
Yes, I'm unsure as to exactly whose side I'm on there. His basic idea was stop burning all this cash, and Bob Iger, in fairness, may well have been of a view of, we need to stop burning all this cash, guys, anyway. He didn't particularly need Nelson Peltz to tell him that, and that was one of his kind of lines of response, right? It was, he hasn't said anything we didn't already know and weren't already thinking about, which is consistent with him then doing it.
Yeah.
But I was interested in... I don't think they're, by the way, getting into sports in a big way. I think there is tough competition with pretty deep pockets there from the likes of Amazon and Google to a point, YouTube and
Apple, maybe.
And Apple. And I think that's... If they're retreating away from Netflix in a battle, I don't think they want to replace that with a fight for Thursday Night Football or whatever.
I absolutely think there's a space in the market, though, for somebody who just wants to put out really high-quality, irregular content, if you see what I mean. I've been watching the Last of Us series, which is a HBO production, I think. It's out on Sky Atlantic for us folk over the pond, and that is absolutely fantastic, and it makes you think to yourself, if this if Disney could do this, produce content of this level, and then every time something comes out on Disney, you rush to watch it, but then in the in-betweens when Disney's producing something special, you just watch Netflix. I think there's a perfect bit of synergy there, and drop down and compete with the likes of HBO rather than just trying to take on Netflix, Netflix is kind of like scattergun nonsense, isn't it? And they occasionally pull a rabbit out of the hat, whereas Disney, I think, with their experience, should be able to look at shows objectively and know what will work and what won't. And I did see there was a drop in quality from Disney's programming, especially when Chapek was in charge. It felt like, I know that most of these projects were probably Iger projects that Chapek inherited, but they kind of seemed like they were just like, it was like, yeah, just put it out. It's Star Wars, they'll love it. Do you know what I mean? And sometimes you're watching it thinking, well, this isn't very good. This just isn't very good. And I hope that, Iger is famed for his work on the creative side of Disney. I think is probably what he takes the most credit from. And I hope they go back to just making great stuff. I don't care about the crap stuff. Just go back to making great stuff.
Yeah, more great stuff. Why aren't you an activist?
I don't have any money.
Yeah, that's fair enough. It is quite difficult to activist a company like Disney.
I will sell 0.00001% of your shares if you don't reinstate the dividend.
I'll buy them if they don't reinstate the dividend. Would you buy it here?
Yeah, I think so. I don't think this is egregiously priced at all. I was having an argument with somebody on Twitter, Steve, much in the same way that you've been doing, who just said Disney's PE is 68 and it's a load of rubbish and we're going into a bear market and it's going to go to PE of 10. And I just said to him, PEs just do not exist in a vacuum. If you were looking at the parks and media business and that was the only thing Disney had and it was at 68, you'd be like, something's gone horribly wrong here. But, it's quite obvious to just look one line further down the statement to see what's happening to Disney's earnings. And then you can just adjust that PE to, what it should be. Look, let's not lie to ourselves. Disney isn't in the greatest shape it's ever been in. It's got a lot of debt. It's got the Fox product that arguably hasn't been very well integrated, especially for the price they paid. It's not added a lot of value to Disney as a company. But from here, looking onwards, because that's what we're doing today. If you're buying Disney today, you're not buying it for its history, unfortunately. You can take part in that, you can take some sort of incentive from its history, but you're actually looking at its future now, and I think Disney from here is quite well positioned to do pretty well.
Yeah, you can absolutely think its history is relevant to its future because a lot of its back catalogue will stay that way. But yeah, you're right, we're buying it looking forward. So we're buying it at today's prices with today's debt load, which is a thing that Peltz made a thing out of, I think, which I kind of agreed with him on. It does look kind of debt heavy, and then that, I guess, also plugs into the point about laying off a load of people and then paying a dividend rather than clearing out some of that leverage.
I would much sooner them clear out the debt. I don't mind them getting rid of headcount. Get rid of the headcount. Get that balance sheet back looking pristine, and then do whatever you want with the free cash flow that generates. What we don't want is Disney's debt rolling over into these high interest environments, because that would be bad.
That would be bad, yes. They took debt at a time when it was okay to do that. I can't remember what their credit rating is, and maybe we'll find out further down the line. I kind of also think it's an okay buy here, especially if it's come back down again today. Nothing in the report particularly caused me to want to buy it more expensive than I wanted to buy it yesterday, though, I think is the way I would put this.
Yeah, but I don't think it's a particularly expensive buy. In the vein that I don't really think much of big tech at the moment is a particularly expensive buy. Maybe, except for Microsoft. That's probably the only one that I look at and think, I'm not sure I can get there. I'm not sure I can get to that valuation.
Yeah, I think I agree. That's the only one still at a PE of around 30, and PEs, of course, is all you need to look at for valuation.